Right now, as you're watching this, the largest wealth transfer in modern history is accelerating, and most people have no idea it's happening. Let me show you something that should concern you. Central banks around the world just added over 1,000 tons of gold to their reserves in a single year. That's not normal. In fact, it's more than double what they were buying just a few years ago. These are the same institutions that have access to information you and I will never see. They're moving massive amounts of capital into physical gold, and they're doing it quietly. Why? Because they know something. They understand that we're at an inflection point in the global financial system. The rules that have governed money for the past 50 years are changing, and when the dust settles, there will be two groups of people: those who positioned themselves correctly and those who didn't. Let me take you back to a moment in history that mirrors what's happening right now. It's August 1971. President Nixon appears on television and announces that the United States is closing the gold window. No longer can foreign governments exchange their dollars for gold. The Bretton Woods system, which had backed the dollar with gold since World War II, is dead. Most Americans didn't understand what this meant. They went about their lives, trusting that their dollars would maintain their value. But something profound had just happened. The dollar was now a pure fiat currency, backed by nothing but faith in the U.S. government. What happened next? Gold, which had been fixed at $35 an ounce, began to rise. By 1980, it hit $850. That's a 2,300% increase in less than a decade. The people who understood what was happening and moved into gold early didn't just preserve their wealth. They multiplied it many times over while everyone else watched their purchasing power evaporate through inflation. We're living through a similar moment right now, except this time the stakes are even higher. Look at what's happening with the dollar's role as the world's reserve currency. For decades, countries around the globe have held dollars because they needed them to buy oil, to trade internationally, to settle debts. The dollar was the undisputed king of currencies, but that dominance is cracking. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to create alternatives to dollar-based trade. They're settling transactions in their own currencies. They're building new financial infrastructure that bypasses the dollar entirely. And they're backing these efforts with gold. China has been particularly aggressive. While they don't always report their full gold holdings, analysts estimate they've been accumulating thousands of tons over the past decade. Russia has more than tripled its gold reserves since 2008. These aren't random decisions. These are strategic moves by nations that see the writing on the wall. But here's what makes this moment different from 1971. Back then, the average person couldn't easily buy gold. There were restrictions, limited access, and most people didn't even think about it as an option. Today, you can position yourself exactly like these central banks are positioning themselves. You have the same opportunity they do, just on a different scale. The question is, will you act on it? Let me show you what's driving this urgency right now. The United States national debt just crossed $36 trillion. Think about that number, $36 trillion. The interest payments alone on that debt are now over $1 trillion per year. That's more than the entire defense budget, and it's growing exponentially. How does a government deal with debt it can never repay? Historically, there are only three options. You can default outright, which destroys your credibility and crashes your economy. You can implement brutal austerity measures, cutting spending and raising taxes, which is political suicide. Or you can inflate your way out of it, print more money, devalue your currency, and make the debt worth less in real terms. Which option do you think they'll choose? They're already choosing it. The Federal Reserve's balance sheet exploded during the financial crisis, then again during the pandemic. They printed trillions of dollars out of thin air, and while they've tried to reduce it slightly, the trajectory is clear. When the next crisis hits, and there will be a next crisis, they'll print again. They have no choice. This is why gold is moving. It's not speculation. It's not a bubble. It's a rational response to monetary policy that has gone completely off the rails. Now, I want to address something important because this affects a lot of people watching this. If you have retirement savings, a 401k, an IRA, money you've worked decades to accumulate, you need to understand how vulnerable that wealth is right now. Most retirement accounts are heavily weighted towards stocks and bonds. Both of these assets are denominated in dollars. If the dollar loses purchasing power, your retirement savings lose purchasing power, even if the nominal numbers look fine. You might have $1 million in your account, but if that $1 million buys what 500,000 used to buy, you haven't preserved your wealth. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the markets right now. Silver is telling an even more compelling story than gold, and most people are completely missing it. While gold has been hitting new highs, silver has been relatively quiet. But that's about to change, and when it does, the move could be explosive. Here's why. Silver has a unique position in the market. It's both a monetary metal and an industrial metal. Gold is primarily monetary. People buy it to store wealth. But silver is used in solar panels, electric vehicles, electronics, medical equipment, and countless other applications. As the world electrifies and technology advances, industrial demand for silver is surging. At the same time, silver production is struggling. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. When those metals aren't profitable to mine, silver production drops. We're seeing mine closures, declining ore grades, and underinvestment in new projects. Supply is constrained just as demand is accelerating. Now add in investment demand. When investors start moving into precious metals, they often start with gold because it's more familiar. But once they understand the silver story, the supply constraints, the industrial demand, the historical gold-to-silver ratio, they start buying silver too. And because the silver market is much smaller than gold, it doesn't take as much capital to move the price dramatically. Let me give you some numbers to illustrate this. The entire above-ground supply of investment-grade silver is estimated at around 2 to 3 billion ounces. At current prices, that's roughly $50 to $75 billion worth of silver. Compare that to the stock market, which is worth over $50 trillion, or the bond market, which is over $100 trillion. Silver is tiny. What happens when even a small percentage of that larger capital starts flowing into silver? The price has to rise. There's simply not enough supply to meet a surge in demand without significant price appreciation. We've seen this movie before. In 2011, silver went from around $18 an ounce to nearly $50 in just a few months. That's a 180% gain in less than half a year. And that was during a time when the monetary situation was far less precarious than it is today. But here's what most people don't understand about that 2011 move. It wasn't random. It was driven by a perfect storm of factors: quantitative easing from the Federal Reserve, concerns about the European debt crisis, and a surge of investment demand from people who saw what was coming. Sound familiar? We have all those same factors today, except they're amplified. The money printing is larger, the debt levels are higher, the geopolitical tensions are more severe, and this time we also have the industrial demand story on top of everything else. Let me tell you about something that's happening right now in the physical silver market that should alarm you. Premiums, the amount you pay above the spot price to actually get physical metal, have been elevated for months. When you go to buy silver coins or bars, you're paying $3, $4, sometimes $5 over spot price. That's not normal. What this tells you is that there's a disconnect between the paper price of silver, what trades on the COMEX futures exchange, and the physical price of silver, what it actually costs to get metal in your hand. The paper market says silver is around $25. The physical market says it's worth $30 or more. This disconnect can't last forever. Eventually, the paper price has to catch up to the physical reality. And when it does, we could see a repricing that shocks people who aren't paying attention. Now, let's talk about what's happening with the US dollar on the global stage, because this is the foundation of everything else. For decades, the dollar's reserve currency status gave the United States an extraordinary privilege. We could run massive trade deficits, print money to finance our spending, and export our inflation to the rest of the world. Other countries had to hold dollars, so they absorbed the consequences of our monetary policy. But That arrangement depended on trust. Countries held dollars because they believed in the stability of the U.S. economy, the rule of law, and the sanctity of property rights. They believed their dollar holdings were safe. That trust is eroding. When the U.S. froze Russia's dollar reserves after the Ukraine invasion, it sent a message to every other country. Your dollar holdings are only safe as long as you do what Washington wants. That's a dangerous message to send when you're the world's reserve currency. China watched that happen and accelerated its de-dollarization efforts. Saudi Arabia, which has priced oil in dollars for 50 years, is now open to accepting other currencies. Even traditional U.S. allies are diversifying their reserves, holding less dollars and more gold. This is a slow-motion crisis. It won't happen overnight. But the direction is clear, and the implications are profound. As demand for dollars decreases, the value of the dollar will decline. And as the dollar declines, the price of hard assets like gold and silver will rise. Let me paint you a picture of what this could look like in practical terms. Imagine you're retired, living on a fixed income. Your expenses are $3,600 a month. Mortgage or rent, food, utilities, healthcare, the basics. You've saved $500,000, and you're drawing it down slowly to supplement your Social Security. Now imagine inflation runs at 7% per year for the next decade. That's not hyperinflation. That's not a worst-case scenario. That's just persistent, elevated inflation like we saw in the 1970s. In 10 years, your $3,600 monthly expenses become $7,100. Your $500,000 in savings, even if it's earning some return, has lost massive purchasing power. You're forced to draw it down faster than you planned. Your retirement security evaporates. But what if you had moved 20% of that $500,000 into gold and silver 5 years ago? What if you had $100,000 in physical precious metals? If gold and silver simply keep pace with inflation, you've preserved that portion of your wealth. But historically, during periods of monetary instability, gold and silver don't just keep pace. They outperform dramatically. That $100,000 could become $200,000, $300,000, or more in real purchasing power. This isn't speculation. This is what happened in the 1970s. This is what happened in the 2000s. This is what happens every time governments debase their currencies and people lose faith in paper money. Now, I want to address the skeptics, because I know some of you are thinking, gold and silver don't pay dividends. They don't generate cash flow. Why would I hold them instead of stocks or real estate? It's a fair question, and here's the answer. Gold and silver are insurance. They're not your entire portfolio. They're the portion of your wealth that you absolutely cannot afford to lose. Think about it this way. You pay for homeowners insurance every year, and you hope you never have to use it. You're not trying to make money on your insurance policy. You're protecting yourself against catastrophic loss. Gold and silver are financial insurance. They protect you against the catastrophic loss of purchasing power that comes from currency debasement. And unlike your homeowner's insurance, which expires worthless if you never have a fire, gold and silver retain their value indefinitely. But here's the beautiful thing. This insurance policy has actually been one of the best performing assets over the past few decades. Gold has outperformed the stock market since 2000. Silver, despite its volatility, has delivered extraordinary returns during its bull market phases, so you're getting insurance that also appreciates in value. Let me tell you a story about a man I know who understood this principle. Back in 2008, during the financial crisis, he was in his early 50s, working a good job, had about $400,000 in his 401k. He watched the stock market crash, saw his account drop to $250,000, and realized how vulnerable he was. When the market recovered, he made a decision. He moved 25% of his retirement account into a gold IRA. His financial advisor told him he was crazy. His friends thought he was paranoid, but he did it anyway. Over the next 15 years, that gold position became the best performing part of his portfolio. While his stocks had good years and bad years, the gold just kept climbing. When he retired last year, that 25% allocation had grown to represent 40% of his total retirement savings. It gave him security and peace of mind that his friends, who stayed fully invested in stocks, don't have. He's not worried about market crashes. He's not worried about inflation. He's not worried about the dollar losing reserve currency status, because he has a significant portion of his wealth in an asset that has held its value for 5,000 years. That's the power of positioning yourself correctly before the crowd figures it out. Now, let's talk about timing, because I know that's what everyone wants to know. When is this wealth transfer going to accelerate? When should you act? Here's the truth. Nobody can predict exact timing. But we can look at the conditions that precede major moves in precious metals, and we can see that those conditions are present right now. High government debt? Check. We're at levels that have never been seen in peacetime. Expansionary monetary policy? Check. Interest rates are still historically low, and the Fed has shown it will print unlimited amounts of money when crisis hits. Geopolitical instability? Check. We have wars, trade tensions, and a fracturing of the global order. Loss of confidence in fiat currencies? Check. Central banks are buying gold at record pace because they don't trust each other's currencies. Rising inflation? Check. Even with the Fed's attempts to control it, inflation remains elevated and could easily resurge. All the ingredients are in place. The only question is, what will be the catalyst that causes the general public to wake up and start moving capital into precious metals? It could be another financial crisis. It could be a currency crisis in a major economy. It could be a geopolitical event that disrupts global trade. It could be the Fed pivoting back to aggressive money printing. Or it could simply be the slow, steady realization that the dollar is losing its purchasing power and there's no way to stop it. Whatever the catalyst, when it comes, the move will be fast. By the time it's obvious to everyone, the easy gains will be gone. The people who profit most from major market shifts are the ones who position themselves early, before the crowd arrives. Let me give you a framework for thinking about this. There are 3 phases to every major bull market in precious metals. Phase 1 is the stealth phase. This is where we are now. Prices are rising, but slowly. The mainstream media isn't paying attention. Most investors are still focused on stocks and real estate. The only buyers are central banks, sophisticated investors, and people who understand monetary history. Phase 2 is the awareness phase. This is when prices start rising faster. Mainstream media begins covering it, and early retail investors start buying. You see headlines about gold hitting new highs. Financial advisors start recommending a small allocation. FOMO begins to build. Phase 3 is the mania phase. This is when everyone wants in. Your neighbor is talking about buying silver. Coin dealers can't keep inventory. Premiums explode. Prices go parabolic. This is when the real wealth transfer happens, from those who waited too long to those who positioned early. We're in phase 1 right now, transitioning toward phase 2. You still have time to position yourself before the crowd arrives. But that window is closing. Here's what you need to understand about physical precious metals versus paper alternatives. When you buy gold or silver ETFs, you own a claim on metal, but you don't own the metal itself. You're trusting that the ETF actually has the metal it claims to have, that it's properly stored, and that you'll be able to redeem it when you want to. During times of crisis, those assumptions can break down. We've seen it before with other assets. When everyone tries to redeem at once, you discover that the paper claims far exceed the physical metal available. Physical metal in your possession, or in a secure vault that you control, eliminates that counterparty risk. You own it. It's yours. Nobody can freeze it, confiscate it, or tell you it's not available. This is why central banks hold physical gold, not gold ETFs. This is why wealthy families have held physical precious metals for generations. They understand that in times of real crisis, possession is everything. Now, I'm not saying you should put your entire net worth into gold and silver. That would be foolish. Diversification is important. But having zero exposure to precious metals in this environment is equally foolish. You're taking on enormous currency risk without any hedge. A reasonable allocation for most people is somewhere between 10 and 30% of their investable assets. If you're younger and have time to recover from market volatility, maybe you're on the lower end. If you're closer to retirement and can't afford to lose purchasing power, maybe you're on the higher end. But the key is to have some exposure, to acknowledge that the monetary system we've relied on for 50 years is under stress, and to position yourself accordingly. Let me tell you what's going to happen to the people who don't act. They're going to watch gold go to $3,000, $4,000, $5,000 an ounce. They're going to watch silver double, triple, quadruple, and they're going to tell themselves they missed it, that it's too late, that they should have bought when prices were lower. But here's the thing. Even at higher prices, gold and silver will still be the right place to be if the dollar continues to lose value. The question isn't whether gold is expensive at $3,000. The question is whether the dollar is worth holding at all. This is the wealth transfer I'm talking about. Wealth is moving from people who hold depreciating paper assets to people who hold appreciating hard assets. From people who trust the government to manage the currency responsibly to people who take responsibility for protecting their own purchasing power. You get to choose which side of that transfer you're on. Think about the retirees who lived through the 1970s. The ones who kept all their savings in cash and bonds watched their purchasing power get destroyed by inflation. The ones who moved into gold and silver not only preserved their wealth, they thrived. Think about the people who held German marks in the 1920s, or Argentine pesos in the 1980s, or Venezuelan bolivars in the 2010s. The ones who trusted their government's currency lost everything. The ones who held hard assets survived. This isn't fear-mongering. This is history. This is what happens when governments print too much money and accumulate too much debt. The currency loses value, and people who hold that currency lose wealth. The United States is not immune to these forces. We're not special. We're subject to the same economic laws as every other country in history. And right now, we're following the same playbook that has led to currency crises time and time again. The difference is, you have the ability to protect yourself. You have access to the same assets that central banks are accumulating. You can make the same decision that wealthy families have made for generations. The question is, will you? Or will you wait until it's obvious to everyone, until prices have already moved significantly, until the easy opportunity has passed? I can't make that decision for you. But I can tell you that the people who look back on this moment 5 or 10 years from now will fall into 2 categories: those who acted when the signs were clear and those who wished they had. The wealth transfer is happening. The only question is whether you'll be on the receiving end or the losing end.